Hey everyone, buckle up, because today we're diving deep into the world of Philip Fisher and his investment philosophy. We're going to be exploring his book, Common Stocks and Uncommon Profits, which, even Warren Buffett considers it a major influence.
It's true. It's a classic. And while the title mentions common stocks, don't be fooled. Fisher's wisdom applies to uncovering the potential of any great business, really, whether you're buying stock or just looking for, inspiration.
And here's a fun fact right from the get-go. Even Fisher's own son found it hard to get stock tips from him. Talk about a tough crowd. It seems like Fisher was all about really, really getting to know a business inside and out.
Absolutely. And that's where his concept of scuttlebutt comes in. Fisher believed that just relying solely on financial reports, it's like judging a book by its cover. You're missing the real story.
Okay, so let's unpack this scuttlebutt idea a little bit. What's that all about?
Imagine you're piecing together a puzzle, but you're missing half the pieces. Scuttlebutt is like finding those missing pieces, but through conversations, not just reports.
So it's about digging deeper, talking to people.
Precisely. Customers, competitors, former employees, anyone who can offer a unique perspective. Fisher believed that this kind of firsthand insight, it could reveal a company's true potential, even if the numbers weren't, screaming it from the rooftops.
Can you give us an example from the book, a time when scuttlebutt would have given someone an edge?
Yeah, so Fisher, he shares a story about a company whose stock price plummeted after what seemed like a really minor management change. And just a quick glance at the financials wouldn't have, told you much. But through scuttlebutt, through whispers in the industry, you would have heard that the new CEO was alienating key employees and long-term clients. And, that kind of insight, that could save you from a disastrous investment.
Wow, that's a really powerful example of how crucial it is to look beyond just the surface. Now let's dive into Fisher's famous 15-point checklist for finding companies with this uncommon potential. 15 points, that sounds a little overwhelming, but I'm guessing it boils down to a few core themes, right?
You're right. Think of these points as the DNA of an outstanding company, grouped into 3 core categories: growth potential, management quality, and operational excellence.
Okay, so let's start with growth potential. What kind of things did Fisher look for here?
He believed that truly exceptional companies, they have this insatiable hunger for innovation. They're investing heavily in research and development. They're consistently creating new products. And they have a real knack for, marketing and selling those products effectively.
And it strikes me that this ties back to scuttlebutt. You can't always find this kind of information just by reading a company's annual report.
You're absolutely right. Talking to customers, industry experts, even competitors. That's how you uncover if a company is genuinely, on the cutting edge or just playing catch up. It's about reading between the lines.
So it's not just about what a company says it's doing, but what others are saying about them.
Exactly. It's about getting the inside scoop, the real story. Now, the second category, management quality. And for Fisher, this wasn't just about having a charismatic leader at the helm. He looked for something deeper.
What do you mean? What else matters when it comes to management?
Fisher believed in the power of a really strong leadership team, a deep bench of talented executives with a shared long-term vision. And it's not just about vision either. He was a stickler for integrity. He sought out companies with leaders who acted as stewards of shareholder capital, people who treated the company as if it were their own, not just out for a quick buck.
Makes sense. I mean, if you're going to trust a company with your investment, you want to know that the people at the top share your values. So that's growth potential and management quality. What about operational excellence? What does that entail?
So think of operational excellence as the engine room of a well-run ship. It's about efficiency. Companies with uncommon potential, they're masters of cost control. They have really streamlined production processes. And they consistently deliver above-average profit margins. They're not just good at what they do, they're exceptionally efficient at it.
Now I have to ask, did Fisher believe that a company needed to be perfect on all 15 points to be considered a worthwhile investment?
That's a great question. And it gets to the heart of Fisher's, pragmatic approach. He knew that you weren't looking for unicorns here. No company is going to be perfect on all 15 points. The goal is to find companies scoring exceptionally well on the points most relevant to their particular industry.
So it's about understanding the nuances of each business and prioritizing the points that matter most in that context.
Exactly. A deep understanding of the industry is crucial here. So, for example, let's just use real estate expertise. So in his book, Fisher points out that this is like make or break for retailers, but not as important for a tech company. Right? So it's about being discerning and understanding the specific drivers of success in each sector.
Makes perfect sense. Now, this next principle from Fisher is a little bit counterintuitive. He believed that when to sell is more important than when to buy. Can you elaborate on that a little?
Yeah, you know how people say, nobody ever went broke taking a profit. Well, Fisher might have disagreed. He saw selling too quickly as a rookie mistake, especially when it came to those, uncommon companies that we're talking about.
So he was a fan of letting your winners run?
He was. So imagine holding on to Apple for decades, even when, everyone thought it was overpriced. That's the kind of conviction that Fisher, championed. He argued that selling too soon, it robs you of the magic of compounding, that snowball effect of growth, building upon growth over the long term. He wasn't interested in small, quick wins. He was after the big, life-changing returns that come from long-term ownership of truly exceptional businesses.
And to illustrate that, are there any compelling examples in the book of companies that truly rewarded those who held on tight?
Absolutely. Fisher, he talks about Motorola and its incredible growth trajectory. And those early investors who stayed the course for decades, they saw their investments multiply many times over. And Fisher argued they succeeded because they understood a fundamental truth, which is selling too soon, it often means missing out on the biggest gains. They let their winners run.
That's fascinating. Okay, so we've covered Scuttlebutt, the 15-point checklist, and the power of letting your winners run. What's next on our deep dive into Philip Fisher's world?
Well, now we're going to dive into something Fisher called the fourth dimension.
Okay. That sounds intriguing, almost mysterious. What's the fourth dimension all about?
It's about understanding the impact of the financial community's perception on a stock's price. It's not just about a company's actual performance, but how the market views that performance, which sometimes can be wildly different.
So it's about recognizing that stock prices can be influenced by, hype or fear or even just plain old misunderstanding.
Exactly. Human emotions, they play a huge role in the stock market, and sometimes they override logic and reason. Think about those times when a perfectly good company's stock tanks just because of a rumor or an overblown news cycle.
So how does this fourth dimension actually play out in the real world? And more importantly, why should our listeners care?
It creates opportunities, buying opportunities. You see, if a company is fundamentally sound, but it's undervalued by the market because of some, negative perception, that's where savvy investors can find incredible deals.
So it's like finding a hidden gem that's been mislabeled in a dusty old antique shop.
That's a great analogy. Fisher understood that, the market isn't always rational. And these mispricings, they can mean big wins for investors who can see through the noise. He gives this fascinating example of the machine tool industry back in the 50s. They were seen as highly cyclical, risky at the win of the economy.
What was happening? What was the market missing?
Companies were, becoming more diversified, adopting new technologies.
Yeah.
There were signs of long-term growth that challenged the old assumptions. But the market, it hadn't caught up to this new reality yet. So for those who saw the shift, who understood the disconnect between perception and potential, it was a chance to buy into some incredible companies at bargain prices.
So the lesson here is that sometimes it pays to be a contrarian. To zig when everyone else is zagging.
Exactly. But that takes courage, which is why,
Right.
Doing your homework, the scuttlebutt, the deep analysis, that gives you the conviction to make those, bold moves when the opportunity arises.
Now, speaking of courage, let's talk about something that strikes fear into the hearts of even the most seasoned investors. Market crashes. What did Fisher have to say about navigating those turbulent times? Did he have any advice for staying calm when everyone else is panicking?
He did. Remember, Fisher was writing during, the Cold War, the Korean War, times of immense geopolitical uncertainty. He saw firsthand how fear and panic can drive markets down, even when the businesses themselves, are still fundamentally strong.
So what was his advice? Basically, don't freak out.
In essence, yes.
Yeah.
He believed that those who panicked and sold during downturns, they were often selling at the worst possible time.
Yeah.
Locking in losses and missing out on, opportunities.
Mm-hmm. It's easy to say don't panic, but our human instinct is to like run for the hills when the market starts tumbling.
Right.
How did Fisher suggest we fight that urge?
He believed knowledge is power. Remember his whole idea about the fourth dimension? How market perception can be so divorced from reality? Well, market crashes are like a prime example of this. He saw them not as disasters, but as chances to buy great companies at a discount, almost like a clearance sale for discerning investors.
I love that analogy, but how do you know which sale items are actually good deals and which ones are like just falling apart?
That's where your scuttlebutt, your research, your deep understanding of the businesses you're invested in, that's what allows you to separate the wheat from the chaff. It's like having a secret decoder ring that lets you see value where others see only chaos.
So it sounds like Fisher was really emphasizing the importance of having conviction in your investments, a belief rooted in, thorough research and a deep understanding of the businesses you own.
Absolutely. He believed that if you'd done your homework, if you truly believed in the long-term potential of your companies, you'd be less likely to panic and make like rash decisions when the market threw a curveball. You'd have the confidence to weather the storm.
Makes sense. But let's be honest, even the most legendary investors, they make mistakes. Did Fisher ever admit to any like blunders, times when he didn't follow his own advice?
He did. He was refreshingly honest about his own, fallibility. He talks about a time in the early 60s when he got caught up in the hype surrounding this supposedly revolutionary new drug. It had all the makings of a blockbuster. The company was making big promises. Investors were clamoring to get in on the action.
Right. Sounds like a recipe for disaster. What happened?
The drug was a flop. It didn't live up to the hype. The company's claims were, exaggerated. Yeah. And the stock price crashed. And Fisher admitted that he'd gotten swept up in the excitement and hadn't done his usual rigorous due diligence.
It's a good reminder that even the best investors are human. We all make mistakes, but it's what we learn from those mistakes that really matters, right?
Precisely. And Fisher's willingness to share his own missteps, to show his vulnerability, it makes his insights all the more valuable. He wasn't afraid to say, hey, I messed up here and this is what I learned from it.
That's what makes his work so relatable and enduring. He's not preaching from some like ivory tower. He's sharing his experiences, the good and the bad, to help others on their investing journeys. Now let's circle back to this idea of market timing, because I think it's something that a lot of investors, myself included, we constantly wrestle with. We've established that Fisher wasn't a fan of trying to predict short-term fluctuations, but did he offer any guidance on when to buy or sell? How did he approach those decisions?
He did. Remember his belief in letting your winners run? Well, that meant being willing to buy stocks even when their prices seemed high, especially if you believed that the company's long-term potential justified the price tag. He understood that exceptional companies often trade at a premium. You're paying for quality and future growth.
So he wasn't afraid to buy stocks that looked like expensive on the surface. Didn't that kind of go against the grain of traditional value investing?
It did, in a way.
Yeah.
But Fisher wasn't just looking for bargains. He was looking for, exceptional businesses. And he was willing to pay up for quality. He believed that focusing solely on low prices could lead you to mediocre companies with like limited growth potential.
But how do you know if a high price is justified? If you're getting a good deal for that premium, or if you're just buying into like the hype? That's a fine line to walk.
It is. That's where all the other principles that we've discussed come in. Your scuttlebutt, your understanding of the company's management, its growth potential, its competitive advantages. All those factors help you determine whether a seemingly high price is actually a good value, a worthwhile bet on the future.
So it's about looking beyond just the current valuation and focusing on the company's like long-term prospects, imagining what that company might look like in 5, 10, even 20 years.
Exactly. And Fisher would argue that the same logic applies to selling. He believed that if you'd done your homework and were convinced of a company's long-term potential, there was no need to rush to sell just because the stock price had gone up.
So even if like the market is euphoric, everyone's shouting, sell, 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 you might be better off holding on tight.
You might be. Remember the Motorola story. Those who held on for decades saw incredible returns. They understood a key principle, which is selling too soon. Getting spooked by short-term fluctuations often means missing out on the biggest gains.
Okay. Now let's tackle something that might seem a bit controversial, especially to income-focused investors. Fisher's views on dividends. They were a little bit unconventional, weren't they?
They were. Unlike a lot of investors who, they love a steady stream of dividend income. Fisher actually preferred companies that reinvested their profits back into the business.
Yeah.
He saw it as a sign of ambition, a belief in their own future.
That does seem a little counterintuitive. Don't most investors want that reliable income from dividends? They do. A
No.
lot of folks see those dividend payouts as like a sign of stability, a way to get a little something back while they're holding on to a stock long term. So why did Fisher prefer companies that reinvested their profits? What was he seeing that others weren't?
Fisher believed that for truly ambitious companies, for those with their eyes on explosive long-term growth, reinvesting profits was like pouring fuel on the fire. It allowed them to innovate faster, expand into new markets, basically compound their growth at a much faster rate.
So he was willing to sacrifice that immediate income for the potential of much larger gains down the road, playing the long game as always.
Exactly. He saw dividends, in a way, as a sign that a company had, maybe run out of ideas for growth. They were content to just distribute the profits instead of reinvesting in a bigger, bolder future. Fisher was drawn to companies that were hungry, that were constantly pushing the boundaries of what was possible.
That's a fascinating perspective. It really challenges the conventional wisdom about dividends. It makes you wonder how many investors missed out on huge gains by prioritizing a steady income stream over the potential for exponential growth.
It's an important question to consider, for sure. Fisher would argue that chasing dividends could sometimes lead to, investing in mediocre companies just because they offer a high yield. He was all about finding those truly exceptional businesses, the ones with the potential to, disrupt industries and change the world. Those companies, he believed, were the true wealth generators. So he was looking for the companies of tomorrow, the ones on the cusp of something big, not just the reliable dividend payers of today. Precisely. And that's what makes Fisher's approach so timeless, He understood that real wealth, life-changing wealth, is built by finding those rare companies that can sustain their growth over decades, not just years. And that kind of growth often requires bold investments, not just steady payouts.
It's a powerful reminder that investing isn't just about picking stocks. It's about understanding the businesses behind those stocks, seeing the bigger picture, and having the conviction to stick with your winners even when, the crowd is getting a little antsy.
Well said. And I think that brings us to the heart of Fisher's philosophy. He wasn't just trying to teach people how to make money in the stock market. He was trying to teach them how to think like owners, how to see the world through the lens of long-term growth and value creation.
And to find those uncommon companies, it takes more than just looking at the numbers, right?
Yeah.
We have to understand the people behind those numbers, the ones driving those companies forward. That's where this idea of the human element of investing comes in.
Exactly. Fisher believed that judging management was one of the most critical factors in evaluating a company. He knew that even the most brilliant business plan could fail if it was in the wrong hands. He'd seen it happen. Early in his career, he made some, costly mistakes by underestimating the importance of strong leadership.
So how did he go about assessing management? Was it all about scuttlebutt, or were there other things he looked for?
Scuttlebutt was definitely crucial. Hearing what employees, competitors, and industry insiders had to say about the leadership team was invaluable. But he also looked for specific qualities in a company's leadership structure. He wanted to see a deep bench of talent, not just a one-man show.
He was looking for a team effort, people who could work together to achieve something great.
Exactly. He looked for leaders with integrity, vision, and a proven track record of making sound decisions, even under pressure. But beyond that, he also paid attention to a company's culture. He believed that companies with a strong, positive culture, a culture of innovation, collaboration, and employee empowerment, were far more likely to succeed over the long term.
So it wasn't just about the CEO, but the entire organization, the environment they'd built, and the values they embodied.
Right. Fisher understood that a company is only as good as its people. And the best investments, he believed, were in those companies that cultivated an environment where talented, passionate people could thrive and do their best work.
That's a powerful insight. It reminds us that investing isn't just about numbers and charts. It's about people, their passions, and their drive to build something meaningful and lasting.
It is. And it brings to mind another famous quote, this one from Benjamin Graham. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. Fisher understood this deeply. He knew that in the short term, stock prices could swing wildly based on emotions, rumors, and all sorts of, irrational factors. But in the long run, the true value of a business, the value created by its people, its products, its impact on the world that would eventually be reflected in its stock price.
So it's about having the patience, the discipline, and the foresight to look past those short-term fluctuations and focus on the underlying fundamentals. Easier said than done sometimes.
Absolutely. It takes practice. And it takes a willingness to, think differently, to embrace a long-term perspective.
Which brings us back to Fisher's emphasis on scuttlebutt, on getting beyond the hype and the headlines to truly understand the soul of a business.
It's about seeing the forest for the trees, It's about having the courage to trust your own judgment, even when the market is telling you something different.
Now, before we wrap up our deep dive into common stocks and uncommon profits, I want to touch on one final point that I think speaks volumes about Fisher's character and his legacy. He placed a high value on ethical investing, on aligning your investments with your values.
He did. Fisher believed that the best investments weren't just profitable, they were also contributing to a better world.
He believed in investing in companies that were making a positive impact, not just generating profits at any cost. It wasn't just a moral imperative for him, but a smart business strategy as well.
Exactly. He understood that companies with strong values, a commitment to their employees, and a focus on sustainability were more likely to, build trust with customers, attract and retain top talent, and ultimately create lasting value for all stakeholders.
He was ahead of his time in that regard. Today, we see more and more investors, especially younger generations, who want their investments to reflect their values, who want to support companies that are making the world a better, fairer, more sustainable place.
It's encouraging to see, and I think Fisher would be thrilled about this shift. He believed that investing wasn't just about building personal wealth, it was about using your capital to create a better future for everyone.
And that's a powerful reminder that we have choices as investors. We can choose to support companies that align with our values, companies that are working to solve the world's biggest challenges, not just pad their bottom line. It's about recognizing that our investments have the power to shape the kind of world we want to live in.
Well said. And it speaks to Fisher's broader vision, his belief that investing could be a force for good in the world.
So as we wrap up this deep dive, I want to leave our listeners with one final thought from Philip Fisher. The best investors are those who are constantly learning, always seeking new knowledge, and never afraid to challenge conventional wisdom. He saw investing not as a get-rich-quick scheme, but as a lifelong journey of discovery, a process of constantly refining your understanding of businesses, markets, and the world around us.
He was a firm believer in doing the work, digging deeper, asking the tough questions, and being open to new ideas. He saw this not as a chore, but as an adventure, a chance to learn and grow alongside the companies he invested in.
What a fantastic note to end on. It's a wonderful reminder that investing can be both intellectually stimulating and deeply rewarding when approached with the right mindset. A mindset of curiosity, patience, and a genuine desire to understand the forces shaping our world.
It's about more than just picking stocks. It's about engaging with the world around us, supporting businesses we believe in, and using our capital to create a brighter future.
Well said. Thank you so much for joining us today on this deep dive into the brilliant mind of Philip Fisher. Until next time, keep learning, keep exploring, and keep seeking out those uncommon opportunities to make a difference.